In this lecture, we are covering the market cycle, one of the most important skills that a real estate investor can develop. To explain the market cycle, we have developed a framework that will help us simplify the enormous complexity of the world into a model that is easier to understand. The model we've built is similar to a supply and demand model used by economists to explain how price is the interaction of demand and supply. There are two main variables that we are interested in when we analyze the real estate cycle: property values and how they change over time. The model works in the following way. We assume that property values move in cycles, and then we assess how the change in the cycle impacts the behavior of other real estate players, such as banks, investors, and how these interact with each other at every point in the cycle. With this model, we assume that property price variations over time are taken as a given, and every other phenomenon we observe is a direct result of these changes. We are not so much trying to explain why prices change, but how the market participants' behavior changes as a result of their perception of the real estate cycle variations. We divide the entire cycle into 4 stages: deceleration, contraction, recovery, and expansion. Let's go into each stage in detail. We begin the explanation with the deceleration phase. What is characteristic about the deceleration phase is that property prices are beginning to fall. This change is normally brought about by a deceleration in the economy or by reasons that are specific to a sector, such as consumers taking their shopping online and away from shopping centers, causing investors to lose interest in the sector and property prices to fall. With the deceleration phase, it is common to see a pricing mismatch between buyers and sellers. Buyers, anticipating a drop in prices, are reluctant to buy into a falling market and adjust their expectations accordingly, demanding bid cuts in prices. Sellers may or may not be willing to accommodate buyers in pricing, and this normally results in a mismatch between buyers and sellers. This mismatch results in the inability of the market to clear product, so that property values stagnate or they start falling. Another effect is a severely reduced transaction volume, impacting the business models of consultancies that depend on it. With transaction volume in decline and buyers and sellers unable to clear the market, property prices begin to fall, but the occupier market, which takes slightly longer to adjust, may prove to be somewhat more resilient. Movement in the capital markets normally precedes movements in the real economy. The combination of falling property prices and rents that remain constant has the effect of stagnating or increasing cap rates, which may make the market slightly more attractive at this point. What is peculiar about this point in the market is the profile of investors that are still active. Core investors, representing the most conservative end of the spectrum, tend to follow the crowd and are generally wary of contrarian investment strategies. So, following the previous 2 stages of the market cycle, they will remain actively pursuing deals until there is a clear indication that we are in a bear market. In contrast to core investors, opportunistic investors are not actively investing in this stage, as they have been priced out of the market for a while. It is more likely they will be actively raising capital in anticipation of a turn in the market. Finally, lenders are also likely to begin tightening credit at this point, making it harder to secure financing. The contraction phase is the epitome of the bear market. At this stage, property prices are severely declining. Sellers have come to terms with big adjustments in values of their properties, and buyers are being aggressive in placing their offers. At this stage, prices have retreated substantially, in excess of any correction in rents. The combination of these two have led to rising cap rates. Despite the big increase in yield, however, few buyers are interested in buying into a falling market. Such is the psychology of human nature. People tend to follow the crowd. There is a big amount of closure that people get in knowing they are not alone, especially when it comes to big decisions such as putting your capital at risk. The instinctive mind that takes comfort in the company of its peers overrides any rational decision-making, calling it to stay away from the market. This results in a severe decline in transaction volume. The lack of buyer pressure and the paucity of deals causes cap rates to stabilize or even rise. This is the reason core investors tend to stay away from the market at this stage. But opportunistic investors, being the contrarians that they are actively pursuing deals and buying property. It can also be expected for lenders to be out of the market. Despite the attractiveness in pricing, returns may be short due to the limited availability of debt. This is the big opportunity for alternative lenders, where they can make equity-like returns with the safety net provided by debt. This is the stage of the market when distressed deals get done, as over-levered property owners, affected by the decline in rents, are forced to hand over the keys to their properties to opportunistic investors or to their lenders. The recovery phase is when things are starting to look good again. With signs that the trough in the economic cycle may be past, this is when prices are slightly picking up again. At this point in the market, more and more investors are returning. Buyers and sellers are aligned, and the market is able to clear deals. Transaction volume is picking up again. Cap rates are stabilizing or declining. At this point in the cycle, there is plenty of activity throughout the capital stack. Investors, core through opportunistic, and lenders are all actively pursuing deals. The expansion phase is the quintessential bull market. Investment volume is strong, and property prices are rising, and cap rates are compressing. Core investors are particularly active in this stage, and opportunistic investors are less so. Credit is also plentiful. This is the stage where buyers are exceeding sellers in terms of expectations, engaging in bidding wars, and driving up property prices. Now that we've studied the real estate market, let's look at how past real estate market cycles have fared and what we can learn from them. As always, feel free to email or contact me via Instagram if you have any questions. I'll see you in the next lecture.